It was August 13th, 2007. I woke up, I got a call from my buddy, and he said, "Hey man, it's over." And I said, "What's over?" He said, "The real estate run and my business." And I said, "Well, what do you mean?" He said, "Wall Street just stopped buying all of our debt." He ran a mortgage shop that was just turning, I don't know, about $100 million. So they would lend it out, they would create the paper, and then they would go sell the paper to Wall Street. They just had a machine. All of a sudden, they went to sell their paper one day, and Wall Street said, "Nope, we're not buying." And that literally was the end of his very lucrative mortgage business. By 2008, the markets were in free fall, and everything was sort of blowing up. Since then, we've seen nothing but manipulation in the market. If there was no market manipulation, we would be able to predict the next thing. But because levers get pulled and buttons get pushed and dials get twisted, it's a little bit of a guessing game to say, what are they going to do next? And I'll give you an example of this. Hey, what's up, everybody? Rob Swanson here, back with another episode of the Real Estate Mogul Show. And today we're going to continue our trend and dive into your questions. It seems like we've got a pretty cool cleanup show. And that is, you've been listening, you've been paying attention, and new questions have come up from previous episodes, and you've shot those questions into us. And I think that's fantastic because that's how we make this show dynamic, interesting, and an ongoing conversation. So the more you engage, the more I can dive deeper and deeper into the topics that you think are truly relevant. And that's a lot of fun for me, at least. I hope it's fun for you as well. So we're going to dive into this and just kind of open things up and jump into our first question. So let's do it right now.
Alrighty, first one comes in from Abigail. You've said before that the best deals come from solving problems. What's your current playbook for identifying distress signals before they surface on everyone's radar or go up on the MLS? Thanks in advance.
Yeah, good question. So what's the framework or the playbook for identifying distress signals? Well, so this is really a list building question, right? And it comes down to finding the prospects, the owners of real estate that sit in a couple of buckets, and maybe even a few buckets. There are sellers or owners of real estate that are not interested in selling. They're not going to sell no matter what. They're either owning and renting the house out, or they're owning and living in the house, or they're owning and they're stubborn and they're just never going to sell that inherited property that's been sitting vacant for the last 28 years. So you have not interested sellers. Then you have interested sellers that are interested in selling. This is what you see oftentimes on the MLS. If you're just looking at the active MLS listings, the majority of houses listed on the MLS are interested sellers. They're not what I would call into the third bucket, or the evolution of an interested seller into a motivated seller. There's no motivation driving them to sell. They're interested in selling. So with an interested seller, a lot of times you're talking about a retail sale, and you're talking about price is the thing that matters most. They want a retail price. They're not going to sell it at a discount. They're not going to sell it on terms. And so an interested seller in the retail world is the majority of owners of real estate that want to sell. When you move from interested seller to motivated seller, what you start to see is these distress signals layer on. And that's really now the crux of your question. What's the playbook for identifying these things? So we usually start with two thoughts. Number one, is the property owner occupied? Or number two, is the property absentee owned? And once we've identified our geography, the location that we're going to target, and we're going to say, okay, in this geography, we want to find the potentially distress in the market, in this little geography. Could be a city, could be a few zip codes, could be a county, could be an entire metropolitan area. Whatever you've selected as your geography, your next step is to find not just interested sellers, but sellers that are motivated to sell. The more motivated someone is an indication of how many distress signals essentially layer on. And let me talk about some of those distress signals. So the length of ownership. After we've determined whether a house is owner-occupied or absentee, or the list we're building, we then start to consider the length of ownership. And length of ownership is one of those non-observable distress signals that some might argue is less a distress signal and more of an indicator. And because the length of ownership for an owner-occupied, if you look at historical trends, an owner-occupied length of ownership breaks into different timelines than an absentee-owned, a landlord or rental house. So a rental house typically, or an investor-owned property, typically breaks into less than a year, 1 to 2 years, 2 to 5 years, 5 to 10, and 10 plus. An owner-occupied property generally falls into the 1 to 3 years. So that initial time frame where we're looking for the non-observable distress or the non-observable indicator of interest in selling is 1 to 3, 3 to 7, 7 to 10, and then 10 plus. And that 10 could even extend out to 7 to 12 and then 12 plus. So the length of ownership is one of the first indicators that you can use to layer an indication of selling on that is not deeply distressed, but it's an indication of selling. Because what the first thing you want to do is you want to target your marketing to people that are likely interested in selling, and then you want to layer on certain distress signals. So I typically tend to focus a lot of my time, energy, and effort in list building in the absentee-owned realm. So most of my lists, I build absentee-owned properties. So once we stack on absentee-owned, length of ownership in one of those time buckets, the longer someone has owned the property, generally the more interested they are in, or the more likely they are to sell that property. And there's kind of a bell curve. A lot of times somewhere in the in the absentee-owned world between 2 and 5 years, if things are not going well, if they're a new landlord, if they're a new investor, and they've gotten into it, they thought it was going to be great, they just find out that they're not cut out for it or they don't enjoy the work, that 2 to 5 years oftentimes bell curves up, and you get a lot of investors that exit in that time frame. Beyond that, it's the 10 plus, because they've got the equity, maybe they've captured the cash flow, and they're moving on to something else in their life, and they want to sell. So I find those two time frames. From there, we start to layer on some different things, some observable distress. We layer on occupancy status. Is the property occupied or vacant? We layer on distance from the owner of the property to the subject property itself. So does the seller or the owner of the property live distant from the subject property? And the farther they live from the property, it starts to become irrelevant, because once you're a couple hours away, maybe over 2 hours plus away from the property, it almost doesn't matter if you live across the country. So there's distance, and that doesn't have to be 1,000 miles is better than 200 miles. Anything that gets 2 hours greater in distance away by driving to the property starts to stack on a distress or a motivation signal. So if a property is absentee owned by an investor, is vacant, the seller lives distant from the property and the seller has owned the property for a long period of time, those are the things that start to stack up. That's a very commonly built list. Now, from there, we start to watch changes. And so in list building, and this is something that we do in FreedomSoft, and we do it really, really well. There are two things in list building. There are really, which is the root of your question here, predictive analytics. So these are things that you use to predict a seller's interest in selling and their likely motivation. And the more predictive elements that you can stack together when you first build your list, the more likely you are targeting a seller that is truly interested and motivated to sell. That's your best prospect. That's your best opportunity. Now, beyond that, the next piece and the layer of this onion is what's called adaptive analytics. And this is where I see a lot of data tools, list builders, CRMs sort of fall short. They allow you to build a list initially with some predictive analytics. You can layer on and you can list stack and you can identify certain things. But then as time goes on, things change. New triggers are exposed, new distress signals show up. And adaptive analytics is saying, hey, this thing changed and it has likely changed the motivation level of the seller. So predictive analytics is done at the very beginning. Adaptive analytics is done over time, and it's measuring the changes in likely motivation of a particular seller. Now, when you can do that across an entire list, when you build a list of 1,000 records or 1,500 records or 5,000 records, and you use predictive analytics to build that list and get yourself down to a list that is likely interested in selling, and you layer on distress signals and you have high probability of motivation, you then turn on the adaptive analytics. And this is done in FreedomSoft with our list automator tools. With daily updates, we look for those changes and we flag things that change over time. So for example, maybe a property goes from absentee owned 12 years. The seller lives distant from the property and the property is vacant. And all of a sudden the property is for sale. And that for sale is a behavioral activity that says they are interested in selling because they just put it for sale. It's then the layers of the distress signals that also give us indication that the seller is probably motivated to sell in some way. Now, what would indicate greater motivation? Well, they list it for sale and then it expires. So an expired listing would further increase the possibility that the seller is motivated to sell. So we've got it listed for sale with all of the other distress signals, and then it expires. And then we see that it comes back on the market, but it still doesn't sell over time. And all of a sudden we see a price drop. Those are behavioral things that a seller is working with, in this case, an active listing, an agent, to do something that is attempting to sell or get rid of the property. And so then we see it expire again. And now you're dealing direct to the seller because the agent is now no longer involved. When you can build a list that is predictive, and then you can track in real time daily and use adaptive analytics to flag your best prospects, you get to win, and you get to win on a regular basis. So that's how I think about it. I think about observable distress and non-observable distress. And I try to layer those things between predictive analytics, building the best list I can at the beginning, and adaptive analytics, watching for the behavioral changes or status changes in public records and in the MLS systems and in activity that a seller is taking along the way to really hone in on the hottest prospects. So great question. I love it. Let's jump to the next one.
Awesome. Real quick, could you just say, and we use FreedomSoft for all of this?
And the thing is, we use FreedomSoft for all of this. And that's the best part about this is you don't have to become a list building expert. That's what I've been doing for the last 25 years. I've figured it out, and I've taken my brain and I've designed it, built it into the FreedomSoft software. So now what a person like yourself, Abigail, gets to do is you get to learn how to push the buttons and pull the levers inside of the software, and all of the 25 plus years of experience is baked in. So let's do this. Great question. Absolutely love it. Let's dive into the next one.
Awesome. Okay, the next question comes from Michael, and this is a two-parter.
Okay.
Rob, how do you personally determine when it's time to exit a property, even if it's still cash flowing? Do you follow any signals or macro indicators that tell you it's time to sell and reset?
Let's stop right there and let's take that one before we go into part two of Michael's question. This is a good question. How do you personally determine it's time to exit a property? There is no perfect formula. You can't just plug it in and spit out a date. I've got to sell on, X date, Thursday, the 38th week of 2020, whatever. That just doesn't work. And so there's an art and a science to this. And it's not perfect. But what I'm going to do is I'm going to step back and I'm going to give you kind of a macro thesis that I have on how I think about owning and selling real estate. Now, the second part of your question, which is going to come up in a moment, is about value investing. And we'll tackle that in a second, but it's a part of this equation as well. As a value investor, what that means is I'm always buying at a discount. So I'm buying on a discount. The more cash I'm putting into the deal, the steeper the discount I need. The less cash I'm putting in, the less discount I need, but I'm always buying at a discount, okay? So number one, knowing that you go into real estate investing with equity because you're buying as a value investor and you're buying at a discount at the beginning, it gives you options. Now, let's insert 123 Main Street, which I just bought at a discount, into the macroeconomic cycle. And most people have probably seen the bell curve that goes from fear and it rises through over time to euphoria, and then it starts to dip and drop, and people are in denial, and then they get into panic, and then they get to the bottom and there's fear again, and then they start to emerge over time back into this euphoric rise. So that's the bell curve of what the market does. I like to buy from the bottom quarter of the back end of the drop through the bottom, and I like to buy all the way through to near the top. And what most people will say is that sets you up for failure. Well, two things. I'm always buying at a discount, so I'm starting as a value investor. I'm also applying market dynamics and market information into my buying decision-making process. So if I buy at the top, I'm not buying in what I call a boom-bust market. Now, a boom-bust market is a market that historically drops 30 to 50% or greater, it really drops. The value of real estate really drops in the crash. I'm not buying if I'm on halfway up that curve through the euphoria and the market is just on fire and prices are rising. I'm not buying in a boom bust market on anything that I'm planning to hold for any period of time. Now, I might buy it cheap, fix it up and flip it quick, but I'm doing something that is quick and I'm being very careful doing that. What I'm doing is I'm buying for the longer hold. So I'm buying in what I call a price stable market. Now let's just contrast these two. A boom bust market appreciates and crashes over time. A price stable market goes up a little bit and down a little bit, and up a little bit and down a little bit. So if I, as a value investor, bought at a discount, even if I bought at the peak of the price stable market, I've bought at a discount that even as the market comes down, my value discount is below the drop. I'm below the bottom. Now, there's another component to this. And so I'm not buying in boom bust markets as we're going through euphoria, because if I did that, if I bought at the top in a boom bust market and the market dropped 50%, I could be upside down. We saw this in the Great Recession back in 2008. A lot of people got completely destroyed for that exact reason. They were in boom bust markets and doing a lot of deals at the height, and the market turned and crashed nearly overnight very quickly, and it took a lot of people out. That didn't happen to me because I wasn't playing that game in a boom bust market. I was buying in cash flow and price stable markets. And prior to the crash, I had been watching the data. This is a part of your question, the macroeconomics. In 2006, I sold most of my real estate. Well, we know what happened in 2007 and 2008. It blew up, right? So in 2007, Wall Street stopped buying the second market debt. And that's when the liquidity in the market completely shifted. And all of a sudden, bank financing and the loan world flipped on its head. It was August 13th, 2007. I woke up, I got a call from my buddy, and he said, "Hey man, it's over." And I said, "What's over?" He said, "The real estate run and my business." And I said, "Well, what do you mean?" He said, "Wall Street just stopped buying all of our debt." He ran a mortgage shop that was just turning, about $100 million. They were turning. So they would lend it out, they would create the paper, and then they would go sell the paper to Wall Street, get their money back, lend it out, create the paper, sell the money to Wall Street. They just had a machine. And all of a sudden, they went to sell their paper one day, and Wall Street said, "Nope, we're not buying." So they got stuck in a liquidity crunch. They didn't have the cash to fund their next month of loans. And he's like, "Man, it's over." And that literally was the end of his very lucrative mortgage business. And that was August of 2007. By 2008, the markets were in free fall and everything was sort of blowing up. The liquidity in the market is the thing that went away. Now, since then, this was 2008, since then, we've seen nothing but manipulation in the market. If there was no manipulation in the market, if there was no market manipulation, we would be able to predict the next thing. But because levers get pulled and buttons get pushed and dials get twisted, it's a little bit of a guessing game to say, what are they going to do next? And I'll give you an example of this. In 2007 to 2008, it took about 14 months for the Fed to drop interest rates to zero to quote unquote save the economy. It took them 14 months to drop the interest rates to zero. Fast forward to 2020, 10 or 12 years later, it took them 30 days to dial the interest rates to zero in order to stimulate economic activity, in order to stimulate liquidity and the movement of money. It's the velocity of money in the equation, and it's the liquidity in the markets that make and break markets. So bankers make and break markets. And so we see all of this manipulation. So a couple of things to kind of put a bow on this. I look at the market type that I'm investing in, boom bust or a price stable market. I make a decision around the type of investing that I'm going to do. Am I here to buy and sell quickly, or am I here to buy and hold over time? As the market rises to what I believe is to go back 15 years frothy level, where the market, where affordability is flipped upside down, where incomes aren't keeping up with rents and prices, even with interest rates going down and adjusting, moving around, I make sure that I'm in a price stable market, and I look for the exit. And here's a couple of things that I look for. I know that if I'm holding the real estate, there are three things that drive the last three housing market crashes. Okay, number one was presidential transition. So in the crash of 1973-74, in the crash of 1990-91, in the crash of 2007-8, there were three things. There were three factors that contributed, that led to the crash. Number one was a presidential transition. And the presidential transition set the flavor for number two, which was economic policy changes or big manipulations of the policy. And number three was then stock market turmoil. So the stock market turmoil was the third and the final indicator that we were moving into some kind of a housing market crash. Now, when you start to look at these three factors and you start to ask yourself, well, where are we today? I look at the affordability. I look at high prices. I look at affordability. I look at where interest rates are. I look at presidential transitions. I look at economic policy. I look at stock market turmoil. And what do we know about stock market turmoil? In each of the last three housing market crashes, you had people that panic, that sell out of the stock market for fear of the market going to zero and them losing all of their investment. So they go from holding equities or holding assets, stocks, to cash. Now, most investors don't want to sit in cash for all of their portfolio. They want their money invested in something. And so what they typically look for is they look for an investment that is backed by something. So real estate is perfect. It's backed by a hard, tangible asset. It's covered by insurance, and it can cash flow on a monthly basis. Those are three things that frustrated or fearful stock market investors that have pulled out of the market are looking for. The problem is those people typically don't want to own real estate. And so they don't want the headaches of the tenants, the toilets, and the trash. But they want the security of the asset, the coverage by insurance, and the cash flow monthly in their investments. And so they tend to gravitate then to lending and buying paper and buying notes. And so when a market crashes and you've been buying and the market begins to go down, how do you sell at an above retail? How do you push the value and force appreciation? Well, you turn your rental into paper, into a note, and you become the bank. See, I just said it a minute ago. Bankers make and bankers kill markets. And so if you want to make or break your own little market, you can go from real estate investor to banker, and you can control pricing, you can control terms, you can control security, you can control cash flow. And so you've got all of these stock market investors that are out of the market looking for somewhere to put their money. You've been in real estate as a value investor, buying and holding, and you now see that the market is beginning to crash. You sell all of your rentals, owner financing, you create paper, you sell that paper to the frustrated stock market investors who don't want to own real estate but want all of the benefits of real estate. You get all of your cash back at a premium, and then you go into the bottom of a boom bust market and you buy at the bottom and you ride that wave back up as a real estate investor. So you go from real estate investor to banker to paper seller to cash holder to real estate investor. It's a transition that happens. So, Michael, I think we covered your question pretty well. And I gave you a lot of the investment thesis that I've developed over the last 25 years and how I think about real estate. And understanding the big picture process is why learning the various skills of real estate investing matters, right? You can buy cash at a discount. You can buy on terms. You can buy hybrid, some cash and some terms. It's the ability to understand how those things shape and formulate a real estate investment asset that can transform from real property owner to lender and vice versa. The creative side of real estate, the reason it's so good to know is because it opens up your exit strategies and allows you to force appreciation and do things that the traditionally thinking real estate investor may or may not have the ability or the know-how to do. So, in one of the recent episodes, I talked about the number one investment that I always tell people to make is in knowledge. Invest in knowledge, learn, and then dive deeper. A few years ago, I did a live event, and it was a live event here in Denver, and what we covered was creative financing and the creation of paper. And how do you do that? And why would you want to do that? And we went deep into the general thesis that I just gave you. We went deeper, and we actually said, okay, what does it look like to build a portfolio that looks like this? And how do you play it in the real world? So what I tell you to do is invest in yourself, invest in knowledge, find those types of things. That was a really cool room. We probably had 50 people at the event. And I'm telling you, there were some high-level guys and gals there that know how to invest in real estate, and they know what they know. And yet they were still investing in themselves to learn something new and just see a different way of applying some of what they already know back into their business. Sometimes it's not learning something new, it's just seeing it from a different lens. And that's what investing in your knowledge can do. So great question. That was part one. Let's dive into part two.
You mentioned value investing and stacking both cash and cash flow. How do you evaluate when it makes sense to take a lump sum gain versus hold for yield, especially in an uncertain market like now?
Yeah, okay, so I think we did cover a lot of this. Let me just put a bow on this part two question on a couple of things. I have mentioned value investing, and I have mentioned taking both cash and cash flow. That comes down to the structure of your deal. And what I'm going to assume is that you are either investing your own cash or you're investing with private capital, private money. And we all have expenses that we need to cover on a regular basis, right? We've got to put a roof on over our head. We got to put food in our belly. We got to put clothes on. We got to pay utilities. We got to, buy gas to get around. We have basic living expenses, and then we have the fun as well. There's the recreational. There's the living life stuff, right? And I'm a huge believer in life by design. I'm a big fan of having a life vision and then designing the things in your life around that vision to get what you want. And so when I talk about cash and cash flow, I'm usually talking about buying a property at a discount. So let's run some tangible, real world math. Let's say that we've got a rental property that's worth $150,000 and fixed up. And let's say that it rents for, we'll just do easy math. It rents for $1,500 a month, and it needs $25,000 in work to fix it up. So we've got $150,000 minus the $25,000. We've got $125,000 as is value. And let's just say, I don't have to run any math. This is not a pod episode where I'm going to talk to you about how to run the math and evaluate a deal. Let's say that I bought that property for $60,000. Okay. So I'm under contract at $60,000 and I know I got to put $25,000 into it. So I'm going to buy it for 60. I'm going to put 25 into it. I'm into it for 85. I know that I'm going to have closing costs. I know that I'm going to have some holding costs. I know that I've got, those things, utility costs. And so let's say that I'm all in at 90 and I end up borrowing 95,000. So let's just do the quick math on this one. 95 divided by 150. I'm going to borrow 63,000 or 63 cents on the dollar. 63% of the fixed up value of the house is what I'm into this for, is what I'm going to borrow. And what did I do? I put $5,000 cash in my pocket. I need $90,000 to do this deal and get it rented out at $1,500 a month. I borrowed 95. So I put $5,000 in my pocket up front. Now that left my lender very, very safe and very comfortable. They're lent in at 63 cents on the dollar. I could even take that up to 70 cents on the dollar, and everybody's going to be happy and comfortable. 70 cents on the dollar, the 150 times 0.7, 105. So I literally could have put $15,000 cash in my pocket up front and had a rentable fixed up house for $1,500 a month. And that $105,000 probably cost me about $600 a month. So if I've got $1,500 a month in rent, I've got 30% operating costs. So I've got $1,000 left after operating costs, and then I pay my $600 payment to my private lender. I've got a $400 a month net cash flow, and I've got $15,000 in hip pocket National Bank. So this comes down to structuring good deals, and you've got to make cash and cash flow along the way as you're building up your cash flow. Eventually, you can stop doing deals and live off of the cash flow. But until you get to that point, until you buy enough real estate and have enough cash flow, you've got to be covering your expenses along the way. And what I just described to you is a way to do that. So that's how I teach people to approach it. and what I have seen work very well. So a lot of people hear this and they say, yeah, but a lender would never give me money that I could put into my pocket. And I would tell you that is the exact opposite from being true. That is true if the lender doesn't trust you. It is not true if you are presenting to the lender and have a relationship and have taken the approach of being a teacher to teach the lender. Most lenders that are experienced lenders, myself included, would look at that deal and say, okay, you're making enough money on this deal up front and even before the cash flow kicks in that you're not going to lose interest. You're not going to take my money, mismanage it, not get this house across the finish line because a better deal that you could make more money to pay your bills popped up. So when I see that you show me that you know how you're making money today and you know how you're getting this deal across the finish line, and I see that it's a tangible asset that my money's secured by, that it's covered by insurance, and that it's going to cash flow positively on a monthly basis, even after paying my debt, I'm happy to see you make money. As an experienced private lender, I want to see borrowers make money. Because if I don't see the borrower showing me how they're going to make money, my red flag filters go up instantly. And I say to myself, the risk level increases. The deal risk itself may not be that great. But if the borrower risk, because the borrower isn't showing me how they're going to make money, is high, then I won't do the deal. So it's the exact opposite of what most people think. Most people think that if I show the lender how I'm going to get paid, they won't want to make the loan. No. Show the lender how you're going to get paid, and they'll be more interested in making the loan because they'll believe that, number one, you're smart. Number two, you understand that you've got to get paid along the way. And number three, that payment buys your attention to get this deal done successfully. So those are the keys to this whole thing. Great questions, Michael, part one and part two. I love it. What else we got, Trevor?
That is time for today.
Wow, I love it. Guys, thank you so much for these great questions. Let's keep the conversation going. Let's just dive into this deeper. If I said something here today that prompts your noodle to say, what is he talking about? Or anything that you'd like to dive deeper into, deeper or laterally, shoot it into me, robswanson at freedomsoft.com, and we'll take your next questions in the next episode. We'll dive in again and have some more fun. All right, guys, thanks for being here. Rob Swanson out. See you next time.